Business model. The next thing we look at as investors is the business model. We want a business model that works. Now, there are two fundamental types of business models. Number one, the ad model, where you get paid by advertisers. And number two, the customer model, where your customer, whoever they are, pays you directly. For the ad model to work, you need to meet some fundamental criteria. First of all, for an ad model to work, typically you need a large user base. If you have a niche audience, a small user base, you will never generate enough money through ads to really hit the revenue numbers you need to hit to grow a unicorn, to grow a multi-billion-dollar business. So you look at the companies with ad models, and they're pretty broad. They reach out to everybody. Like Google. Google is, most of Google's revenue is ad revenue, and almost everybody uses Google. You look at Facebook. They have over 1 billion active users. That's why they generate so much money with the ad model. But I've had entrepreneurs come into me and say, we're targeting a niche audience. We're targeting firefighters, but we want to use an ad model. I'm like, what? There just aren't enough firefighters in the world probably to generate the type of revenue to make you a venture fundable business. It doesn't work that way. If you're going to do the ad model, you not only usually need a lot of users, you also need data. You need to be able to target these users. The companies with ad models that are most profitable have the most data. This is why Facebook makes so much money. This is why Google makes so much money, because they have so much data about you. If you don't have a lot of data on the users, your advertisers aren't going to be able to target their ads to the people they need to reach to actually get transactions, and it's probably not going to be that profitable. The more data you have, the more profitable you'll become. So as an investor, we're looking at this equation. We're also looking at time on site. You may have a lot of users, but if they don't spend a lot of time on your site every day, if they don't come back often, if they aren't engaging deeply, they're probably not going to click on a lot of ads. So all of these criteria are what we take into account when judging whether a company with an ad model is viable, whether it's on track to be a great venture investment. Now let's go to the second business model. The second one is where you get money directly from a customer. There are a couple types of models here that work. You can get money from a customer once, maybe even once in their lifetime or once in a very long time, and you can still be profitable. A good example of this is the automobile industry, right? You sell a product once to a person, they might not come back for 10 years, 5 or 10 years to buy another car, maybe even longer. Depends on how long they want to keep their car. And they might not even come to you. They might go to somebody else because by that time they want a different car. But the profit margin in selling a car is big enough. It's big enough so that they can get that customer once and it's fine. They're making enough money to justify all the advertising they spend to acquire these customers and still make a healthy profit. But there are other businesses where you aren't selling something that is as profitable as a car. You might be selling a gadget, a new device you made. And the prices on these devices may range from $10 to, a few $100s, but the profit margins are usually pretty slim. And where there's competition, where you don't have a unique brand, a unique technology, the profit margins quickly, if people are out there copying your idea, everybody's producing the same thing, quickly shrink to, barely enough. Unless you're a tried and true business where you have massive distribution, you're selling laundry detergent. Laundry detergent may not have the biggest profit model, but you have all the distribution channels, or you're a big electronics maker and you're putting your products everywhere like Sony, then you can make money even off new gadgets, right? Because you have a brand, you have all these things, you have economies of scale. But if you're a startup and you're coming to us with this new gadget or this new thing that people buy once, and most of the time they never buy again. So the typical thing, a lot of startups put up their products like a smartwatch or whatever it is, they put it up on Kickstarter, and then they expect to have a big business. Like Pebble, they started with their smartwatch. They put it up on Kickstarter, they're a startup. They made lots of money. They got, a huge amount of advanced orders. So it seemed like, wow, this is a great business. But the problem with this is you only sell it once. You just sell it once. And then there's so many other people making similar products. How do you stand out from the crowd? And there's people who will undercut you in price. So every time you want to get a new customer after the initial splash, maybe you got some press, you have to actually pay money. And in startups, the two biggest costs that most startups have are their employees, the talent they hire, and their customer acquisition costs. How much does it cost them to acquire a customer? If you're spending more, fundamentally more on acquiring customers than you are making in profit from your product, you have a broken business model. And I have seen so many startups that they look great on the surface, but every time they want to get a new customer, they have to spend more than they can make or close to what they make on their products. And they just end up burning out. They end up going away. Those startups fundamentally are broken. And even if they work, the problem with any product that you sell only once to your customer, and then you have to go out and acquire a new customer to make more revenue, is that it's a very difficult business to scale. It's a tough, once you can do it, you can scale these businesses, especially if you have a unique technology and there are no competitors and you can keep a deep profit margin, especially the more expensive the product, if the more costly the product, the more room there is for profit, then you can do it. But in a lot of cases, I see these startups that, they have an amazing product. There's definitely a need out there. They've proven people want it, but they just can't grow. They end up they shoot up, maybe they launch and then they plateau, and it's very, very tough. It's a bad venture investment. The business model that we like the most in Silicon Valley from the vast majority of startups is not a one-time sale. It's what we call recurring revenue. It means you go out there and you get a customer and they keep giving you money. And over the lifetime of that customer, even if they're giving you small amounts of money, it can add up to an enormous amount. So let's look at the successful companies are out there, the biggest and best companies, and see what business models they have. Well, we've already talked about Facebook and Google. They have the ad model, but the ad model is also a recurring revenue model. They're getting money from advertisers, but over and over and over. Well, if you're getting money from customers, you can have that same model. Look at Amazon or Alibaba. They're recurring revenue models. Every time they get a little bit of the sale, but there are enough sales that Amazon is getting money on these sales. And then Amazon and Alibaba also use advertising. They make a huge amount of money from advertising. So the combination of these two, because they have such an enormous amount of usage, adds up to a lot of money over the lifetime of the customer. You look at a company like Uber. They don't have any ad model, but every time you use an Uber, you're giving them money. So this is why investors got so excited by Uber. This is why they valued it so highly, because they saw basically that if you want to get a driver, every time you have to go back to Uber, and every time you ride in an Uber vehicle, they're making a little more money, which adds up to a lot of money over their lifetime. Now, investors in Uber may have got too excited. They may have pushed the value too high, so it had to adjust downwards. But even then, it's still a good business model. That's what we look for as investors. Fundamentally, where the lifetime value of a customer, as long as you can expect to own a customer, most customers that sign up for Amazon or Alibaba or Uber or any of these services or any of the SaaS models, they usually stick with that company pretty long if they have a good service. So we'll measure that. We'll look at, what is the lifetime of the customer? How much can you make? And then a venture capitalist will do the math. This is fundamentally doing the math and basically seeing, wow, over that lifetime, you have a really significant profit margin. And this is what venture capital is good at. Venture capital will look at the future and say, you may be losing money now. You may not be you may actually be in the red, but that's because initially acquiring the customer, it takes a while for that customer to pay for himself or herself. So it's going to take a while for these customers to mature and you to get your money back. But once they paid for themselves, everything else is profit. Then you're really making money. So we as venture capitalists will advance you the money. That's essentially what venture funding is. It's an advance on the money, and in exchange, we are getting a share of your company because we can see in the future that you are going to become highly profitable. And what you need to do now is dominate the market, get as many customers as fast as possible. So a lot of the software as a service companies, use recurring revenue. In fact, that's the fundamental model, a subscription model. And that money can add up fairly fast because software tends to scale really well. The costs, you can have a very, very healthy profit margin in software. Software is also very flexible. You can update it, add new features, do upsells very easily. Keep charging that customer more. Software, a lot of SaaS companies scale by the number of users, by the amount of usage. All of these things bode well for that type of recurring revenue business model. So again, think of business models. They aren't that hard. If you're an investor and you're looking at startup, you can look at these fundamental principles of business models, see if they map to the startup you're looking at, and then you can start to gauge the potential. If this startup achieves, if it's a big market with a lot of users and a lot of recurring revenue, even if each transaction is very small, but you're getting transactions frequently, how much money will that add up to? Will this become a unicorn? And if it is, that's when we make the decision, yes, this is the type of company we want to invest in. I hope you enjoyed the talk. If you liked it, share it with your friends or subscribe to our channel. You can also come to founderspace.com and check out our 3-month online startup program, as well as my books, Make Elephants Fly, Surviving a Startup, and The 5 Forces. I'm also available on all the major social networks. Just search for Founderspace.